Hey there, this is Mike Durr, Kingwood Mortgage Guy. I am so glad that you're going to watch this video today. Been working in the Kingwood area for the last 27, 28 years, and I'm here just to answer any questions you might have. I was recently asked a question about how somebody could improve their credit or their credit scores so that they'd qualify for being able to get a mortgage. There's a lot to that. First thing, even if you already qualify to get a mortgage, increasing your credit scores will help you a lot just because it will lower your rate. Having higher credit scores helps your rate. So a lot of people can benefit from some subtle tips and strategies that we use to increase people's credit scores. So the first thing that a lot of the lenders do is they look at the credit score and the credit. What happens is you kind of put yourself in a category by what your credit score is. And an example of that is if you are below, let's just say, go low. If you're below 550, you are probably not going to get a mortgage at this particular time. I mean, there is a slim chance, but it's not a very good chance to get a mortgage with 550. When you get up to 580, all of a sudden the opportunities become much better at that point because you've met what's the minimum credit score for an FHA loan. When you get to 620, you've met the minimum requirements for a conventional loan. But the real place you really want to be is you want to be in that 700 plus range. And that allows you not only get a conventional loan, but to get a pretty good rate. So that's kind of how it breaks down. The FHA, you can get a really good rate anywhere in the mid 600s. But on a conventional loan, you probably will not want to do a conventional loan if you're below 700. Now that's not a absolute, but that's pretty good guarantee that you would probably do better doing an FHA loan. So it's going to vary, but I will tell you, if you're above 740, that is generally going to be a conventional loan, and you've basically eliminated all the hits or the dings that you get for credit. So what happens is if you're at 739, your credit score is hit because you're not 740. The next level of that is 719. So between 720 and 739 is a category. Between 700 and 690, or well, actually 699 and 680, so every 20 points is a layer of risk. And you get above all those layers of risk at 740. The higher, the better, is the bottom line. The better scores happen when you're up sneaking around 800. The first thing is, will you qualify based on your credit scores? The next thing they do is you have to understand that the lenders are always looking to mitigate their risk, or their biggest fear is that you don't pay the money back. And to mitigate that risk, they look at the lower FICO scores or the lower credit scores with the ways to offset that risk. With conventional loans, it's with mortgage insurance. With the FHA, it's mortgage insurance. But they're different the way that they handle that. The point is, the higher your credit scores, the less risk there appears to be to the lenders. And what they do is, let's just say a 700 FICO score person might qualify for a loan with 3 to 5% down. Whereas if you have a 620 FICO score, you may have to put 10% down. And that's not exact. That rolls over into the non-QM products. Suffice it to say, the higher the credit score, the less money down, the better the rate. Okay? That's kind of in general. Two main things. One thing is, a lot of people, younger people, a lot of times don't understand how credit affects them in their life. They don't understand that there's a measurement on how they are handling their credit scores. And I see a lot of guys, particularly, I don't want to rule out girls, but I would see more guys that are, I call them young and dumb. They are moving fast and loose. They've got a job, they pay their bill, they buy things, but they don't always pay attention to paying their bills on time. I see that a lot. And it's like a wake-up call. Oh, well, you want to buy a house now? Well, you should have taken care of your credit prior to that. The other one's kind of interesting is there are people that get in trouble with credit. And what happens is the natural tendency is you just say, I'm done with credit. I don't need credit. I'm just going to operate with cash. And that is basically what they're left to do. Here's where the mistake happens, is the only thing that shows up on their credit is the past negatives that they have. And so what you have to do is you have to kind of rebuild that credit. And it doesn't take long. I've got a very specific track for them to follow to rebuild that credit after they've had a year or two of no negative credit. So the key parts are that if you have bad credit right now, you can fix it. That's one thing. Credit is dynamic. It's fixable. It has a kind of like when you have a negative on your credit, it lasts for so long, but it doesn't last forever. So there's always a way to resurrect your credit. And in some cases, there are certain tricks that we use that will actually allow you to increase your credit quite fast. And the first thing is to make sure that you're paying all your bills on time as agreed. So, it seems simple, but a lot of times people fail to do that. They'll pay their bills, they just don't pay them on time. So there is an amount of time that people expect to get their money. The second thing you can do, if you don't have credit cards, I know this is going to sound crazy, but you need to have credit cards. Credit cards are a big part of where the score comes from. The third thing is the way that you handle the credit cards is a big deal. You've got to be very careful about using the maximum limit that they give you. And some people go, well, wait a minute, they gave me that limit, I'm supposed to use it. No, they give you that limit, but you really want to use 10 to 20% of that limit. And then you want to pay it consistently every month and pay it off every month. Some people would argue that you don't pay it off. I say pay it off every month. Use 10 to 20% of the limit that they give you and then pay it off. So those are two big ones. The third one that I'm going to tell you is one, it's called the authorized user. And there are some people out there that this is probably one of the fastest ways for somebody that didn't have any credit to get good credit is you get somebody to allow you to be an authorized user on their credit cards. Now you want to be discerning and careful about who you choose to do this with. Generally, it's a family member. It could be a parent, could be a grandparent, could be a sibling. But when you do this, they're basically giving you their history of using their credit card. So it's got to be good and they've got to have space. And it's not like you're going to go out and use this card. You are just going to have access to that and it will report on your credit report. You get a couple things. You get the benefit of their good payments. You also get the history, because one of the key factors on when they're judging your credit is how long you've had credit and how you've handled your credit over that period. So those three tips will get you a long way. Well, thank you for watching this video. Hopefully you're not one of those people that has credit issues, but you may know somebody that has credit issues. I'd love it if you'd give them my name or maybe even forward this video to them. And I'm Mike Durr, the Kingwood Mortgage Guy, and I look forward to seeing you on the next time.